nice one. Hi, Vic.
You can call us on 011-2803-899 with questions about any shares.
That's Talking Technical. If 150 hours of your favorites still look like this, it's time you upgraded to this. No timers, no tapes, no hassle. Record and store up to 150 hours of programming directly to hard drive with DSTV's HD PVR decoder. DSTV, more for you.
Welcome back. Now, with multi-decade interest rate lows around the world, there's a lot of uncertainty about when policy normalization will take place. What will it entail and what the risks would be? So to help us unpack this, I'm joined on the line by Wikus Furstenberg, who is Portfolio Manager at Future Growth. Wikus, thanks for your time this evening.
Hello, Siki. Thank you. You're most welcome.
And I want to get to the question of what normalization would mean, what would be normal global interest rates. But before that, I think maybe let's just unpack the situation we're in right now. Both locally and globally, we're seeing interest rates at multi-decade lows. If that carries on for a while, is that a risk factor?
Certainly so. I think we know there are good reasons why interest rates are at these multi-decade low levels. We all know about the so-called negative output gap globally, disinflation or low inflation, especially in developed markets, and we know that some central banks are actually trying to sort of inflate. The Bank of Japan, the most recent good example of that. Locally, is slightly different, but nonetheless, I mean, the repo rate sitting at the lowest level since the early 1970s. I think in terms of normalized or normal, you probably need to take your cue from real interest rates, and over time, you know, it depends on the country. If we could sort of maybe focus on South Africa, for a while, you know, it was very clear that the central bank always targeted a real rate of somewhere between 2 and 3%. And clearly, and that's also a function of where inflation is, inflation expectations, and one would think it's probably going to be lower if you have a lower inflation issue. But clearly, if you look at markets globally, South Africa in particular, you look at real rates, they are very, very low. And I think many portfolio managers, they battle with that one, especially at the moment. You know, you've seen foreign flows into the South African market again, and it's actually pushing our yields to very unsustainable low levels. And it's not to say it's going to be the end.
But I'll ask you this, Wikus. I mean, does it necessarily follow that because interest rates have stayed low in South Africa for so long, that the only way for them now would be to go up for normalization to take place?
Not necessarily. I mean, that's the issue. I think it's easy to say rates are low, and because they are so low, they've got to go up. It's really a function of what's going to happen to growth, what's going to happen to inflation, and not even sort of just high inflation. I think the reality is that even if we see higher inflation in South Africa, headline CPI, for instance, north of the 6% target, and growth falters, I think it's going to be very difficult for the central bank to simply hike rates.
Mohammed wants to ask you a question.
Wikus, hi. I mean, regardless of how obscene this extended interest rate cycle is globally, it almost looks as though, especially over the last week, the emphasis has shifted away from austerity and towards pro-stimulus, with the latest rumors being that the ECB is going to be considering a cut at next week's meeting, or at least some form of stimulation. What's your view on that? Because certainly that precipitates an extension of this trend. We've seen that 186 locally trade to record lows, and this wash of money really finds its way into South Africa and leads to these extended situations in the local market as well.
Certainly. I think in terms of the ECB, obviously there are market rumors. We know what's happening in Europe. Draghi himself indicated last year he'll do whatever it takes. And that's what markets are pricing at the moment, that you're going to see further easing. Whether they're going to cut rates or not, I mean, to us it doesn't really matter. The fact is, even if they don't cut rates next week, or they don't announce more measures in terms of quantitative easing, it doesn't really change the picture. The picture is that globally, central banks, mostly in developed markets, are still inflating this liquidity balloon. And as long as they do that, with or without the ECB next week announcing additional measures, I'm afraid to say this blind rich or search for yield will continue, and you're probably going to see the impact on the local market as well. And quite frankly, the market is very, very expensive at these sort of levels. It's not necessarily going to stop foreigners from buying more, because they look at these yields very simplistically and they compare that to what's offered elsewhere globally.
Okay, we'll leave it there. Interesting. I wonder. Thanks, Wikus. Wikus Furstenberg is portfolio manager at Future Growth. Very quickly, before we get into the clicks discussion, if we are facing a long-term interest rate bear market, what would that mean for investors, particularly those invested in the bonds, in fixed rate bonds?
Yeah, I think if you look at that, your investors maybe preferring to minimize the risks of a turn in the interest rate cycle, and how one would do that is by effectively moving their exposure towards very much the shorter end paper that's out there in the market. By and large, the consensus right now, flatter rates for an extended period of time, simply because, as Wikus said, this wash of money globally is coming to South Africa because it's this global hunt for yield.
It's the hunger for yield. Well, increasingly, the theme among South Africa's retailers is pressure on its middle-class customers, and Clicks is no exception. Constrained spending resulted in interim turnover growth of 11.4%, while diluted headline earnings rose 8.5%. The dividend is 10% higher. Earlier, Julietta spoke to David Neal, Clicks chief executive, and asked him if he was worried about increasingly cash-strapped customers.
Look, I think we're having to adapt how we run the business to the fact that our middle-income customers are under pressure.